Hello guys and welcome to the Elon Markets YouTube channel. You may remember my video on CAN-SLIM mechanism where we had 7 criteria to identify a good business for investment. Well, today we are going to learn something similar which has 9 criteria, but it is completely fundamental based concept developed by Joseph Piotroski, who was an accounting professor in Stanford. This concept is known by the term Piotroski Score. Here, a company is given a discrete score between 0 to 9, which reflects a 9 criteria and helps us to determine the strength of a firm's financial position. Now, for every criteria that a business entity meets, it is rewarded by 1 point, and for every criteria which it fails to meet, no points are awarded. The points are then added to determine whether that business entity can be regarded as one of the best value stocks. Yes, Piotroski score helps to identify value stocks having good potential. Value stocks are those which trade at a lower price relative to its fundamentals and are thus considered undervalued by investors. The common characteristics are low multiples like PE, price to book value ratio, etc., and also high dividend yield. Coming back to the main topic of our video today. A score between 0 to 3 is considered low, those between 7 to 9 are considered high, and a score of 4, 5 or 6 is said to be an average score. And similarly, a high score means a really good stock and vice versa. Now, these 9 criteria can be segregated into 3 broad sections: profitability, leverage and liquidity, and lastly operating efficiency. The favorable conditions or criteria under profitability include: number 1, positive net income in the current year, which shows if the company has made profits in the current year. Some people also calculate this criteria as higher net income in the current year as compared to the previous year, to calculate if there has been an increase in the profits from the previous year. Number 2, positive operating cash flow in the current year, which shows if the company is able to generate sufficient cash flow to maintain or inculcate growth. Number 3, higher return on assets, that is higher ROA in the current year as compared to the previous year, which essentially means how well a company's management is employing company's total assets to make a profit. Number 4, cash flow from operations greater than net income. This shows us the quality of earnings. It is more of a warning criteria because usually CFO is higher than net income as it is not affected by non-cash items, which is why when the reverse happens, one needs to beware. Now, there are 3 favorable conditions or criteria under our second broad topic, leverage and liquidity. First criteria states that we should have lower ratio of long-term debt to total assets in the current year as compared to the previous year. The fact that the amount of assets being financed by debt is decreasing is a good sign, as it indicates that the company is being able to generate sufficient profits to deploy back in the business to grow and continue its operating cycle. Second criteria states that current ratio in the current year should be higher than the previous year. This measures company's ability to pay back its short-term liabilities with the help of short-term assets. And the third criteria deals with dilution of equities. A positive sign will be when no new shares have been issued in the current year. It shows that the promoters of the company have faith in the growth of the business. Now let's discuss the last 2 criteria under operational efficiency. Number 1, higher gross margin compared to the previous year. Well, gross margin essentially tells us the percentage of total sales that the company retains after incurring direct costs. Number 2, higher asset turnover compared to previous year. Well, this just shows how efficiently a company uses its assets. Professor Piotroski in his famous paper explained, that an investment strategy which buys expected winners and shorts expected losers generates a 23% annual return between 1976 and 1996. Yes, it's true that just because an investment strategy has worked in the past, not necessarily will it work in the future. But having an investment plan and rules is never a bad idea. Let me give you examples of a few companies with high and low Piotroski score. High Piotroski score companies include Aarti Industries with a score of 8, Orient Bell with a score of 8, SML Isuzu with a score of 8 again, and Goa Carbon with a score of 7. Now, under low Piotroski score, we have McNally Bharat with a score of 2, Mukesh Steels with a score of 1. Please do remember that this is not an advice to trade or to invest. Okay, so let's make it simpler for you to scan and analyze stocks based on the Piotroski score. We can boil down these 9 criteria to essentially 3 main criteria, being positive net income compared to the last year, higher current ratio compared to the previous year, and higher asset turnover ratio compared to the previous year. The set points essentially focus on 3 simple concepts: increasing earnings, improving financial condition, and improvement in efficiency, which is basically the crux of the factors leading a company to success. Higher net income means greater profits, which can be on account of expansion in products or services, expansion in geography, or perhaps reduction in costs on account of greater efficiency. Higher current ratio implies bigger asset base as a result of better cash flow or better working capital management. Increase in asset turnover implies the more cash being built can be used to quickly convert inventory into cash and boost productivity. With this, we come to the end of our video. And if you think all of the given information was helpful for you, don't forget to press the like and subscribe buttons. Also, if you have any query, please feel free to ask us in the comment section below. Thank you.